The market is currently closed, and Opendoor Technologies closed its last trading session on July 9, 2026 at $5.24 per share, marking a significant upward surge of 9.39% for the day. While most regular traders checking their individual brokerage accounts saw this as just another volatile swing for a well-known small-cap stock, the real surprise lies beneath the surface of the broader housing market data. On the very same day this asset climbed over 9%, official national data revealed that existing home sales actually dropped by 2.4% across the country. Normally, a sharp contraction in home sales would send shockwaves through any real estate business, but the market is beginning to price in a completely different narrative for this specific balance sheet. Institutional buyers are quietly moving capital based on the company's internal inventory turnaround metrics rather than raw macroeconomic volume figures, establishing a massive curiosity loop for anyone watching the real estate sector. When you look at the general consensus surrounding Opendoor Technologies, the common ground among retail investors is easily understood. Most individuals looking for investment help on popular investing sites view this company as a highly speculative, cash-burning experiment that was left for dead when interest rates spiked a few years ago. The collective expectation is that high mortgage rates will permanently freeze housing activity, making it impossible for an automated buyer to flip properties at a profit. However, the emerging reality is turning out to be much more complex and potentially lucrative for those who analyze the underlying mechanics. Instead of being crushed by the slow transaction environment, the firm has structurally adapted its acquisition pricing models to secure properties with far wider margins, allowing it to remain highly liquid even as traditional real estate agencies struggle to close deals. This tension between what the public expects and what the financial statements actually show is driving immense trading volume lately. During the last session alone, the stock experienced a massive surge in liquidity, with tens of millions of shares changing hands as big institutional desks rebalanced their positions. If you look at the trading data across major execution systems like the Interactive Brokers platform, the trading velocity for this asset has outpaced many typical small-cap equities, showing that big institutions are actively picking sides. This kind of intense daily swing is precisely why short-term traders are keeping the stock pinned to their watch lists right next to high beta megacaps like Tesla stock or Nvidia stock. The asset is behaving less like a slow-moving utility and more like a high-tech growth equity, responding sharply to subtle shifts in bond yields and capital flow. To understand why this recent price movement is catching so many analysts off guard, we have to look at how institutional sentiment has shifted over the last 2 quarters. For a long time, large fund managers using sophisticated tools on the Interactive Brokers platform were aggressively shorting the stock, betting that a persistent down market would wipe out the remaining cash reserves. But the recent earnings report disrupted that thesis when the company beat both revenue and earnings per share expectations, posting $720 million in quarterly revenue. More importantly, the business demonstrated that its gross margin has stabilized near 8.2%, backed by an enormous cash pile of nearly $1 billion. When an asset trades near the $5 mark while holding that much liquid capital against its long-term debt liabilities, a short squeeze scenario becomes a real mathematical probability, forcing bears to cover their positions and fueling sudden double-digit intraday gains. If you manage your own capital through a self-investing strategy, perhaps using tools like Schwab Intelligent Portfolios or a standard Fidelity brokerage account, you know that timing these specific macro inflections is incredibly difficult. Many retail market participants prefer the relative safety of online investing through large diversified index products or Fidelity ETFs. But for those looking at individual stock selections within the real estate tech space, the current trading tape shows a classic trending structure, characterized by steadily higher lows and very controlled pullbacks. This indicates that professional accumulating algorithms are building long positions without triggering massive, unsustainable price spikes. This controlled accumulation stands in stark contrast to the erratic retail-driven trading often seen on the Robinhood app, highlighting a deeper layer of institutional support that is keeping the floor from falling out. Please take a moment right now to participate in our channel discussion by interacting below. Comment below how many shares of Opendoor Technologies you currently hold, or if you are completely avoiding the real estate tech sector right now. Hearing your direct strategies helps everyone gauge retail sentiment across different platforms. When we strip away the daily market noise and look at what the business actually does, the core operational model relies on algorithmic property valuation, commonly known as iBuying. The company acts as a direct liquidity provider for homeowners, offering cash for houses based on internal pricing data, performing light renovations, and then reselling the properties directly on the open market. This asset-heavy approach requires massive lines of credit and a flawless understanding of localized property depreciation, which is why older reports from past housing cycles showed massive multi-billion-dollar losses when home prices dropped rapidly. However, the current iteration of the business model is vastly different from past performance, as the management team has drastically limited its total inventory exposure, maintaining a current ratio near 7.1 to ensure they never get caught holding deflated assets during a sudden downturn. Looking ahead at the future outlook, the ultimate trajectory of the stock will depend entirely on how reality continues to match up against market expectations. The key catalyst on the horizon is the upcoming quarterly report scheduled for early August, where analysts will be lasers focused on whether the company can maintain its positive trend in asset turnover times. If mortgage rates begin to ease even slightly later this year, it could unleash a wave of pent-up demand that would allow the firm to scale its transactions exponentially, proving the bears wrong. Conversely, the obvious risk is a prolonged economic stagnation that completely paralyzes consumer moving plans, which would force the business to rely heavily on its cash runway to survive. For individuals evaluating options through specialized digital tools like a SoFi robo-advisor or searching for investment help on prominent investing sites, this asset represents a pure calculation on the normalization of American housing mobility. In summary, the central insights surrounding this real estate tech play show a stark contrast between a skeptical public narrative and an improving operational reality. While the general expectation was that a slowing housing market would fundamentally break the business, the reality of a 9% single-day gain on bad macro data proves that institutional accumulators are looking at internal efficiency rather than external noise. The company enters the second half of the year with a robust cash position, stabilized margins, and an institutional trading volume that rivals major tech names on the Fidelity trading platform or Interactive Brokers trading systems. Whether this momentum can be sustained through the next earnings cycle remains the critical question, but for now, the asset has established itself as an authoritative indicator of hidden strength within the housing technology landscape.